Welcome to Moonstone Update. I'm Mark Beshard, the Managing Editor of Moonstone Publications. Here's a look at some of the stories we covered over the past week. But first, please hit the subscribe button and share this video with your friends and colleagues. Cybersecurity is inching closer to the boardroom, and it's only a matter of time before a failure to implement basic cybersecurity protocols will result in claims against directors and officers in South Africa. This was one of the points made by attorneys from insurance law firm Clyde & Co. In a webinar on cyber claims, they use case studies to highlight important lessons and trends that intermediaries can bring to their clients' attention. The Association for Savings and Investment says the tax regime for retirement savings should not be changed when the two-pot retirement system is introduced. Any changes should only be carefully considered at a later stage if SARS finds that members are using it to derive an unfair tax advantage. Members have expectations about how their retirement fund contributions and withdrawals will be treated, and it would be unhelpful to create uncertainty, particularly while members were getting used to the new system. The FSCA will continue to ensure that insurers adopt a fair and balanced approach towards premium increases. In its Financial Sector Outlook study, the authority said many large insurers have raised their provisions against COVID-related mortality claims, resulting in an increase in premiums, particularly for funeral policies. The FSCA said it has been engaging with the life industry to determine whether the premium increases could be substantiated. Our columnist Paul Kruger this week tackles the issue of disclosure, both at application stage and during the term of a policy. An insurer repudiated a death claim for 10 million rand because of non-disclosure, but changed its mind after consulting the Ombudsman for long-term insurance. Paul discusses the implications of material misrepresentation and the application of what has become known as the Didcot principle. The FSCA has fined the chief executive of Smart Billion Investments 10 million rand and debarred him for 10 years for contravening a number of financial sector laws. Another director was fined 500,000 rand and debarred for 5 years. Smart Billion opened a trading account at GT247, pooled client funds, and traded them in the name of Smart Billion. However, only a portion of the funds that clients deposited into Smart Billion's bank account were transferred to GT247 for trading purposes. The balance was used to pay clients' withdrawals. National Treasury has officially launched its top-up retail bond, offering investors a return of 8.75% with interest compounded quarterly over a minimum investment term of 3 years. The minimum opening investment is 500 rand, and investors can top up their existing investment with a minimum of 100 rand at any time. One of the features of the top-up bond is that individual investors can switch a portion of their investment into a fixed rate or inflation-linked bond during the investment term, provided their capital balance is at least 1,000 rand. Passive manager Satrix won top honours at 2 awards events last month. For the second year in a row, it received the trophy for Best Fund House Larger Fund Range at the Morningstar Awards South Africa. Satrix walked off with 9 of the 26 awards presented at the 5th Annual South African Listed Tracker Awards. For the first time in the 11-year history of the Morningstar Awards, none of South Africa's large asset managers won in any of the fund categories. That's all we have for this week. You can read these stories and many more on our website moonstone.co.za. Until next time, here's wishing you all the best from the team at Moonstone Information Refinery.